Welcome again, guys, to another episode of Finance by Speng. Today, we'll be taking a closer look at cash flow. In our previous video, we zoomed in on balance sheet and your net worth statement. Today, we'll be looking at your cash flow and your cash flow statement and how the money flows through your hand. So, cash flow. What is cash flow? So this is basically the money that goes into and out of your wallet or your bank account. We have two types of cash flow. We have the cash inflow and we have the cash outflow. So inflow, this is the money you receive or income. Examples of this are like a paycheck, some incentives, dividends you earn from investments, or a gift. So if any money that you receive, this is the inflow of money. This is called inflow. Then we have the second aspect of cash flow, which is outflow, and this is the money that you spend. Any money that leaves your wallet or leaves your possession, this is the outflow of money. In order to track your money or to track the flow of your money, you will normally use a cash flow statement. So a cash flow statement, this is a summary of your cash flow during a particular period of time. Normally it's measured within a month or a year. So we normally do a cash flow statement like to check the progress or the flow of our money for a particular month or a particular period. All right. A cash flow statement is basically important because it keeps a track or it helps you to track how your money was received and how it was spent. So it is important when it comes on to budgeting or when it comes on to any form of track list of your money, how it was spent or how it was initially attained. Okay, so when creating your cash flow statement, there are three basic steps by which we have to follow. The first one is to record your income. By recording your income, you are going to list all your sources of income in a given month and record the amount as your cash flow. Ensure that when you're recording your income, you are using your net income and not your gross income. What do I mean by this? Your net income is what you receive after tax, what is available to you, not your gross income. Your gross income is the entire amount before tax. Same for your dividends earning. Whatever you receive on your investments, ensure that you're recording the amount that is available to you and not the entire amount before tax. The second step here is to record your expenses. There are two types of expenses. We have fixed expenses, which are normally the same every month. Say, for instance, your rent or your cable or internet bill, or perhaps your commute to and from work. So your fare to and from work, or the amount that you'd spend on gas to commute to or from work. Then we also have variable expenses, and these expenses vary from month to month. Examples of these are medical bills, utility bills such as electricity or water, or the amount that you spend on grocery monthly. These can change due to inflation or things of that nature. So after you've recorded your expenses, the sum of your expenses is known as your outflow. The third step after recording your expenses is determine your net cash flow. Though, how you're going to do this? You're going to subtract your outflow from your inflow. If you end in the positive, that means you have spent less than you have earned and you have a surplus. Once you have a surplus, this simply means that you have additional money where you can spend or you can save depending on your values or your financial goals. If you have a negative, that means you have a deficit, which means why you have spent more than you have earned, which will normally lead into you going into your savings or borrowing, which will increase your liabilities. So a surplus, depending on your values, normally increase your net worth because probably you've determined that you'd invest your surplus or add to your liquid assets, which is your savings. And a deficit normally increase your liabilities because if you spent more than you've earned, that means you would have went into your savings, taken away from your savings, which will lower your liquid assets, or you'd borrow in order to make up for the deficit, which will extend your debts, which will add to your liabilities. So on the board, we have a typical cash flow statement, and the values are in USD. We have your income here and your expenses here. we will explain this side of the board further down in the video. So first, we'll be looking at your recorded income for a particular month. So here we have your net paycheck after tax that is available to you. We have 1,500. We have dividends on your stock portfolio, $150. Interest on your savings account is $70. And your second income, which is your own personal business, which is bringing in about $600 per month. Your total inflow is $2,320. Now we're going to take a look at your recorded expenses. So we will be looking at your fixed expenses, your rent. You're paying about $500 in rent. Your internet is $50, and your transportation to and from work is about $450. We'll take a look at your variable expenses. You're spending about $400 per month on grocery, your utility bills, which include probably your lights, your electric and water, is about 150, and your medical expenses is also about 150. We see where your outflow is $1,700. So now that you've calculated your expenses, we're going to take away our outflow from our inflow. Once you go ahead and you've done the math, you will have a surplus of $620, meaning by you have $620 remaining from your monthly income. So with your surplus, you have multiple options. You can either invest in assets or invest in your small business, which will eventually lead back to a higher income, which will automatically build and increase your wealth. Or you can spend and increase your expenses, by which you could choose to dine out or go and plan a small trip with your friends or do some additional shopping. Either way, it will affect your cash flow. It either will increase your income or your expenses. For instance, now this was more and we had a deficit instead of a surplus, whereby which we have $620 a deficit, meaning by we spent more than we earned for a particular month. We will see where this will increase our liabilities, whereby which we will either go into our savings, which will automatically reduce our liquid assets, or we'll have to take out a debt, which can be a credit card loan or something, which will increase our debts and increase our liabilities. In the case whereby which we have a deficit, we either have to find a way to reduce our expenses or increase our income. And that is a basic cash flow statement and a depiction of how your cash flows. So based on this example, you're going to go ahead and do your own assessment, do your own cash flow statement, and see where majority of your money is and how you can either increase your income or reduce your expenses. By doing this, it will automatically lead to the building of your wealth. That is it for today, guys. Have yourself a wonderful rest of the day.